Nicholas Nassim Taleb popularized the term black swan in his book of the same name back in 2007. Black swans are unforecastable, sometimes small events that, once they occur, seem almost obvious and yet have profound and lasting effects on our world. At the time, it was written largely in reference to the financial system and how incentives and institutional details can make the most improbable a near certainty. But if 2020 were to have a slogan, it would be "Hold My Beer."
Everyone that is logged in, welcome. It's great to have you with us for our second virtual Atlanta Economics Club luncheon. I am Jessica Dill. I'm the president of the Atlanta Economics Club. I'm also director of the Center for Housing and Policy at the Federal Reserve Bank of Atlanta. Typically, I'd give a few introductory announcements before we kick things off, but we don't have much in the way of announcements this month. The one thing I will mention is that we offer an annual scholarship for current students at local institutions, both undergraduate and graduate students. Our application is live and the application deadline is November 1st. So if you know any students, if you are a student, I'd encourage you to go and apply for that scholarship. I do think we'll issue at least one award, if not maybe two. And so please go apply. So like last month, I'll also give a little bit of a heads up that since we're on Zoom, we invite you to submit your questions throughout the session instead of holding them to the end. And so there is a chat box. I don't see it in the view, but there's a Q&A box, and so please feel free to submit your questions along the way. And without further ado, I'll go ahead and introduce our moderator for today's session, and he'll introduce our speakers. We're very fortunate to have our own Brian Robertson with us. Brian is a quantitative financial markets advisor at the Federal Reserve Bank of Atlanta, and he's also an Atlanta Economics Club board member. He's our director of marketing. He's behind the camera. If you've been to our in-person meetings, you'll know who he is, and you'll see him on camera here. And so, Brian, thanks for moderating today. I'll pass it off to you. Take it away.
Thanks, Jessica. As she mentioned, I am here with the Atlanta Economics Club, also an analyst at the Atlanta Fed. Today's topic is going to be about alternative data. This is something that's very near and dear to my heart as a financial markets guy. I love data, steeped in data. I want it all. Sometimes, however, we find ourselves in situations where we just don't have the data. Nicholas Nassim Taleb popularized the term black swan in his book of the same name back in 2007. Black swans are unforecastable, sometimes small events that, once they occur, seem almost obvious and yet have profound and lasting effects on our world. At the time, it was written largely in reference to the financial system and how incentives and institutional details can make the most improbable a near certainty. But if 2020 were to have a slogan, it would be "Hold My Beer." The speed at which the COVID-19 pandemic has affected our economy and the amount of uncertainty it has created has in many cases outpaced and overwhelmed our traditional methods of economic surveillance. Asked differently, how do you provide a forecast when the entire economy is itself now a black swan? Today we're joined by the AEC's very own Michael Skordeles and Jonathan Smoke to talk about alternative data and how it might allow us to be able to peer into the darkness and shed light on these uncertain times. Michael Skordeles, head of US macro strategy and senior vice president of previously SunTrust, now Truist, investment advisory and portfolio and market strategy groups. With over 25 years of investment experience, his insights into macroeconomic and industry trends, some of which have appeared in Bloomberg, Reuters, New York Times, and on CNBC, helps manage over $11 billion in client assets and supports Truist lines of business. Prior to Truist, Mike was managing director and chief market strategist for Morgan Keegan and market strategist at McDonald Investments. He holds a master's from Georgia Tech and an undergraduate degree from Baldwin Wallace University in Ohio. He is also secretary for the Atlanta Economics Club and is a member of the National Association for Business Economics, otherwise known as NABE, of which the Atlanta Economics Club is a chapter. We're also joined by Jonathan Smoke, chief economist at Cox Automotive. His career spans, like Mike's, more than 25 years, focusing on translating data and trends into relevant, actionable insights for the industries that represent the biggest purchases that consumers make in their lifetimes: real estate and automotive. As chief economist, Jonathan leads Cox Automotive's economic industry insights team, which tracks economy, new and used vehicle sales, supply, prices, retail and fleet demand, consumer credit and auto financing, and dealer sentiment to understand the key trends impacting both the wholesale and retail markets for vehicles, informed by the proprietary data that all the company's businesses and platforms, including Manheim, AutoTrader, Kelley Blue Book, and Deal Track. Prior to Cox Automotive, he held the chief economist roles at Realtor.com and Hanley Wood, and served in a variety of roles at Beazer Homes, including vice president of strategy and innovation. His insights have appeared in Bloomberg, The Wall Street Journal, USA Today, and on CNBC. Make sure to follow him on Twitter at @SmokeOnCars for his latest thoughts. Jonathan holds a bachelor's degree in economics and religious studies from Rhodes College and an MBA from the University of Texas at Austin. So with that, let's hear from our esteemed panelists. Guys, you're up.
Thanks, Brian. I am going to pull up the deck. We thought that we would at least accomplish, if you don't like the discussion of alternative data, we would at least share with you some perspectives about the current market using alternative data. I actually would prefer to focus on the label high frequency data instead, because I'm not quite certain. We have a tough time really agreeing on what's alternative and what's not. Are you guys seeing the deck okay?
I think we all have it. I think we're good.
You're good. Are you on the map? Just wanted to make sure we're in sync.
We're on the title slide here.
Okay. Oh, we're on the title. How about now?
Auto market update and outlook.
Yeah, it should be. All right, then let me try something else.
You want to go to display mode on yours.
Now you should be seeing a map, right?
Beautiful. Looks great.
All right. So I'm starting with the pandemic itself, because this has definitely been a data set that we've all become accustomed to focusing, and it's kind of classic high frequency data, brand new data that none of us had ever dealt with until March of this year. We actually at Cox developed a framework for assessing the risk level related to COVID-19 by geography. So what you see on this map is actually our current county level risk assessment, where we color code each county in the country. This is helpful to us because we've got office locations, we've got auction locations where customers are involved. Cox Communications has their retail stores where consumers are involved, and we have to make decisions about how our facilities, how our people are responding to the crisis. And of course, this has been something that has been evolving, but one of the things that I definitely have learned by focusing on the data is that the US is not going through a single pandemic. We're going through hundreds, if not thousands of pandemics, because they're happening at a fairly granular geographic level. And it's actually interesting right now because we finally, after weeks of summer outbreaks, are hitting a stride where all of the metrics are now moving in the right direction. So daily new cases are declining again, hospitalizations are down and declining, deaths are down and declining. We had a little bit of concern that the college outbreaks that started 2 weeks ago as kids started going back to school, but we really are not seeing that in the latest data. But that's at a national level. When you drill into the counties, actually our risk assessment for 2 weeks going as the trends have started to improve on a national level continue to show that we have more orange and red counties when we refresh this every day, which tells us that there are definitely more challenges, but they happen to be typically in less densely populated areas of the country. The good news is when we look at this through the lens of larger markets, designated market areas, for example, we're now down to only 4 problem markets, 4 that are red in the country. And those 4 markets are in only 2 states. Georgia has 1 with Macon, and the other 3 are in Texas, and they're all border markets in Texas, not any of the very top markets in Texas. So moving into the economy, we're getting into more of the classic, what economists use. And of course, we've been very focused on unemployment. And you're going to see the material that I'm sharing today is extremely consumer centric because of the size of the auto market is very dependent on consumer demand. And broadly, the consumer represents about 70% of the US economy. And with the unprecedented job losses we had back in March and April, even though we've had very strong recovery in the months since, we still have about 13 million on traditional unemployment benefits and an additional factor of contractors and gig workers who continue to find themselves unemployed. And one of the other elements you'll notice in the data that I'm tracking is we look at what we see geographically around the country. And there's quite a bit of difference depending on where you are in the country, where unemployment is even higher than what we see nationally. Specifically, for weeks now, the top 5 states have continued to be Hawaii, Nevada, California, New York, and Connecticut. They swap spots in any given week, but for the most part, those states tend to have a disproportionate number of jobs that are dependent on travel and/or services, and those are the parts of the economy that are likely to continue to have significant challenges as we move forward.
Hey, Jonathan, real quick, got a question coming in from Dawn. On your first slide showing the COVID outbreak data, was it measuring the percentage or a rate?
It's actually an index calculation that I'd be happy to kind of share after the fact on what we do, but it's actually a risk level that's a function of a combination of the factors, looking at daily cases, active cases, and deaths, and we're in the process actually of adding hospitalization to it.
Fantastic, thank you.
Yeah. So we're now to a part of the data that I think you can truly call more alternative data. As the pandemic emerged, we moved to working with the firm Morning Consult to have a more timely measure and actually a deeper measure of consumer sentiment. Most of us who've worked in consumer-related sectors have followed consumer sentiment or consumer confidence our entire careers. Morning Consult is basically following the exact same form that the University of Michigan does with their primary questions. They're just asking those questions daily of a pool of more than 5,000 respondents. So it's a fairly deep survey and a very timely survey. And we're able to get that data within hours of the data being collected each day. And so what you see on this chart is basically the trend that we've been seeing in that consumer sentiment. And that consumer sentiment has been, as you might guess, very predictive of the traditional measures like the one from the University of Michigan. But it's also really informed me a lot about the things that I'd grown accustomed to in the monthly measures that we'll potentially get into discussion when we talk with Mike a little bit further on. But one of the other things that's clearly an advantage of this data is in the largest DMAs in the country, we can actually assess how consumer sentiment is trending by market. And so I've got 2 maps on this slide. The one on the left is showing you the current level of consumer sentiment relative to what they were in February. And if you'll recall from the previous slide, we're right about 20% down for the US in aggregate. But when we break it down by market, we have one green market in the country right now that actually has higher consumer sentiment. That's Sioux Falls, South Dakota. 22 markets are in yellow because they're seeing a less than 15% decline, which is better than the US overall. We've got 106 in that pinkish color. They are more or less tracking with the US, and we now have 13 that have consumer sentiment that's more off than the US overall. And we've found this data to be highly correlated to differences we see in vehicle sales around the country. So not only are we tracking the absolute decline that we've experienced and where we are in the recovery, but we're also tracking the changes that happen week to week. So the map on the right is showing you how many markets were up. There were 72 that are green. How many markets were down? Those are the 53 in the 2 shades of red. And then the yellow 17 markets were unchanged in the past week. So focusing on the consumer, one of the things that we've definitely learned in this is that this downturn was unprecedented in many ways, including how strongly consumer finances have held up. And I can clearly say that our situation today could have been much worse if the U.S. government hadn't acted quickly to support consumers and businesses. We had unprecedented levels of fiscal stimulus, substantially more than took place during the Great Recession. So instead of falling when unemployment was at its peak, incomes actually went up thanks to the CARES Act payments themselves, which were largely distributed in April and May, as well as the enhanced unemployment benefits that lasted until the end of July. At the same time, consumers couldn't spend, so savings shot up, especially in the spring months. And thanks to Mike, he clued me into data like the weekly data on deposits at banks and savings accounts. And we had a number that between the end of February and mid-July, about $1.6 trillion went into commercial bank deposit accounts, largely related to the stimulus. But as we all know, the economy is no longer supported like it had been. Additional stimulus does look like it is needed because of the high level of unemployment, but we've yet to see action from Congress. Now, moving a bit into data that I pay close attention to in the automotive market is we would have expected auto loan performance or credit performance overall to deteriorate at this point, given the high level of unemployed. But because of the stimulus, consumers actually use the extra money to pay down debts or stay current on their debts. And they also benefited from loan forbearances and accommodations that, at least for the auto loan market, have never been like what we've experienced in this year. Auto loan severe delinquencies as a result, which is what's shown here, this is using monthly Equifax data, and we just got the August data in this week, have declined every single month since January this year. And as of August, we're at a 27-month low in severe delinquencies, which are people who are 60 days or more behind on their payments. So what we can clearly see in that data is it would have been worse. And one of the high frequency elements that I've been paying attention to from Equifax is they issue a weekly view of loan accommodations across all credit types. And we had 8% of auto loans receiving accommodation as of the end of June. Currently, as of the last week in August, we're at about 4.2%. So the accommodations are quickly declining, and we would anticipate that we start to see evidence of credit deterioration coming later in the year with a combination of less stimulus and those accommodations starting to decline. Another aspect that is truly high frequency, if you can get access to the right different types of loans, is to see what interest rates are doing. Consumers did not see immediately a result of the Fed's actions. Actually, when the Fed cut to zero in March, we didn't see consumer rates decline at all. We actually saw in March consumer rates went up, which was related to the level of risk and uncertainty that weighed over the economy at that time. The rates did start to fall in April, but you can see we had generally been seeing declines until we hit August, and then in August, the two lines that I'm showing for auto rates increased slightly. But if you also notice the line representing subprime, which is the red one, and it's the only one using the right-hand axis to keep because of the much higher interest rates, you can see that subprime rates are actually higher now than they were a year ago by more than a point. So what we've been seeing in the market is that even though the cost of funds is extremely low, credit tiers are really establishing big differences in the rates that consumers see. And likewise, the mortgage market has seen better declines in rates. And actually, speaking of which, it's a perfect time to show you the effect of really lower rates in a market that's dominated by consumers who can get those rates. We're seeing the housing market really being probably the best performing sector of the economy right now, consistently. We now have both new and existing home sales as of July up year over year, And depending on the metric you want to choose, it's the best year that the housing market has seen since 2005 or 2006. But not all sectors are performing that way. And one of the latest pieces of data that we've been able to start working with is a set of data shown here from Verisk, and this is through Equifax. What Verisk basically does is they track for over 40 million households the credit card and debit card spending, and they're able to provide us summary data within 2 weeks of a week ending by category of how spending looks like. So we see very different impacts depending on the sector you're in, and we've also seen different trends of recovery and more recent trends, as you can see with several different lines on this chart. What we saw is that the overall spending looked to be, in dollar terms, fully recovered in early August, but in the weeks since has softened a bit. The broad vehicle category, which is that line that has blown above everything else in blue, it includes any credit card spending at dealers, so that would include a down payment, maybe a complete purchase of a used vehicle, as well as parts and service, but it also includes parts retailers like AutoZone, and it includes credit card expenditures that you might have for local mechanics and that sort of service company. So it's a very broad category, but you can absolutely see that actually spending is now up on a year-over-year basis. Beneath that, you see spending on gas stations was way off, and that's mostly gas, and that has been improving steadily and has not softened. And then the one on the bottom, which is also auto-related, is car rental spending. And you can see that that continues to be well off, more than 30% off last year. But if you think that's bad, you ought to compare that to what we see with hotel, airline, and other travel categories. And it's interesting to note that even though we're seeing softness in some of the other categories and overall, we're not seeing softness in rental car of late, potentially because of people continuing to spend in August for summer travel in lieu of other types of vacation travel. So back to more of our proprietary data, one of the things that we moved very quickly to do was to have a daily measure of retail vehicle sales across the country using our own data platform. So we created a same store methodology to help us track what that recovery has looked like. And this past week, actually, it's very interesting to be having this discussion today, because normally weekly comparisons year over year are very helpful to judging the recovery. But this past week, we had an interesting shift with Labor Day landing in last year, but Labor Day ended in this week, this year, making the comparisons a little bit soft and making it look like the recovery was a little bit stronger. What we know for certain, and we can see in our data, are some extreme inventory challenges. This chart is showing you what we see in terms of advertised inventory levels of new vehicles across the country by week. And we are now under 2.3 million units, substantially lower inventory year over year and pre-pandemic. And it's notable that the line continues to go down, which is an indication that production of vehicles has not been able to catch up with the pace of sales yet. So we're actually seeing the supply conditions continue to tighten. And we're seeing the same thing in the used vehicle market, which we can measure through data at Manheim or data on the retail side from what we see in terms of what dealers are advertising around the country. Both had very elevated levels of supply back when the country was shut down, but very quickly trended to normal and even below normal levels on the resale side. And what we learned in economics, of course, is that when there's tight supply and strong demand, prices go up. And boy, have we had a roller coaster ride this year on used vehicle prices. This is weekly price data for 3-year-old vehicles. The reason that I choose 3-year-old for a chart like this is that it's actually the most represented vintage in the used car market because of trade-ins and because of off-lease vehicles. Typically a 3-year-old vehicle like a 2017 this year is far more represented than any other age of vehicle in the used vehicle market. And it's indexed on these charts relative to the beginning of the year. So what we see in the prices is that prices declined for wholesale and declined very rapidly as the pandemic began, and we're at the worst point down about 12% from pre-pandemic. But since then, we had an incredible 16-week trend where wholesale prices appreciated. That's right, vehicles gained value over the spring and summer. And as of this week, we now see prices, even though they came down last week a little bit, wholesale prices are up almost 14% from the beginning of the year. And retail prices, which continue to go up, there's a lag between wholesale and retail. Those prices are up by about 9% relative to the beginning of the year. And then rounding out to the theme of paying attention to the geography, we can see in our data, and in this instance, I'm using unique credit applications on our dealer track platform to give me a view of what retail sales likely look like by market. And what we've been seeing is a constantly changing map. The map on the left was the map as of April 5th for that week compared to the same week back in 2019. What we saw were really dismal conditions. There was no market in the country that was up. We had 7 markets that were essentially plus or minus 10% down. And then we had 39 markets, those that were in the shades of red, that were down 95%. The darkest red were down 95% year over year. The map on the right shows you what last week's performance was. The map looks a heck of a lot more attractive than the one on April 5th, but I can tell you the map was even greener and prettier in June and the early weeks of July. Last week, the worst market was Lake Charles, Louisiana, still dealing with Hurricane Laura. We saw improvement week over week with 63 more green markets, so we now have 128 in that map on the right. And collectively, we had about 74 markets were up year over year, which sounds pretty good, but it's nothing like the number that was almost twice that that we had back at the end of June. So that's kind of a view of the market related to the consumer and the economy, and what I've been tracking certainly in the automotive market. Now I'll let Mike jump in and antagonize me with questions about my data before we get into it.
Not at all, not at all. Obviously, Jonathan, you nailed it. I would just highlight a few things from my perspective. Certainly there's been a resurgence in auto production, particularly in July and August. That's helped a lot of the manufacturing related data. Again, I have a macro focus, so macro has been there, as we move through July and August. Certainly we've seen from a trade perspective, Mexico currently, it jumped up to be our largest trading partner, followed by Canada. Through the July numbers. China dropped to number 3. They typically trade between 1, 2, and 3 on those 3, but and certainly you would know that had you attended our AEC December 19 panel that focused on Mexico and the U.S. and trade. Nonetheless, kind of broadening it out, generally we expect, and we've seen already, that the recovery path is more of a swoosh shape as we transition from kind of a very sharp V-shaped initial reaction and it flattening out. We're already starting to see that in some of the data, and that it's going to take some time. We think it's going to be early 2022 before we regain the lost ground from a GDP perspective. Generally, though, very encouraged from the economic trends. Certainly employment has bounced back, as Jonathan mentioned. And has improved dramatically. We've had 4 straight months of off the map, historic, order of magnitude historic. But again, paired up with that order of magnitude awful that was April and May, we're still behind the 8 ball. We do think that we're in a self-reinforcing trend here underway. But this repair process is going to take a while. It's also transitioning, as we're moving through the fall months. Jonathan mentioned some of the stuff with colleges restarting and some stumbling or what have you that's happening. That's impacting things, but this is going to impact the size, particularly in the employment size, for the size of gains as we move forward after that huge initial snapback. We're not going to see those sorts of numbers as we move forward. So while the worst is behind us, at least from our perspective, the biggest monthly gains, again, from an employment standpoint, are in the past as well. Nonetheless, we've seen retail sales. Jonathan mentioned retail sales for autos and what have you. Those have snapped back. They've been quite strong, but general retail sales also, I think, so, there might be some beer sales and alcohol sales to help some of those. Yeah, help the gas stations a little bit. But that we're seeing certainly housing, and Jonathan, you highlighted some of that. Again, manufacturing, especially automotive related. I would also highlight here in the Southeast, there's a lot of tire production. We have a Toyo plant a little north of us here in of the Atlanta area, but there's also a number of Michelin and other plants throughout the Southeast. Their production has ramped up quite a bit after being down for roughly 3 months. But we've seen this production generally trying to make up lost time for the pandemic. So this is going to continue to provide some underlying momentum to help kind of mask, if you will, some of the things that are going on generally. That said, as Jonathan mentioned, travel, leisure, all those sort of industries and a lot of others are greatly impacted, and they're not going to come back for quite some time. And that's why we think it's going to be the balance of 20 and into 21 to see a number of these industries come back. And I have a background here of Truist Park, but they don't have people there. That means a lot of incomes that are impacted for people that work in ancillary and supplementary and adjacent businesses, restaurants certainly, but many other, whether it's parking or other things. And so there's skipped trips to the office for people that's not gas station sales that don't happen, and other things. So there's a lot of economic activity that's not just been delayed, but likely has been, permanently adjusted. So we're going to see that as we move forward. Ultimately, from a reopening standpoint, Jonathan pointed out very well, but just reiterate the fact that we think it's going to be very sluggish and uneven, both by industry, but certainly, as Jonathan pointed out, with the number of those heat maps, is by region and by state. And even within states like Georgia, we're seeing that there are parts in the Atlanta metro that look strong, but then there's plenty of other parts of the state that aren't quite as strong. So that just kind of leave it there for that. But nonetheless, this unevenness, this sluggishness is going to last for some time.
Hey, Jonathan, speaking of gas stations and lending them a hand, I have a question coming from Scott Crooks. Is the gas price data adjusted to reflect lower gas prices, or are those just taken as
that was pure dollar? And actually gas prices have been relatively stable for the last 3 months. This week's move in oil might cause actually gas prices to come down a tad. So I think most of the gains, other than the beer that Mike mentioned, has probably been, growth in driving, because we can see that in some of the mobility metrics that people are tracking now coming from INRIX, Apple, Google, and others, which may be a good segue to Mike.
Actually, before we transition, we got one more question from Laura Wheeler. She's asking, do you foresee a long-term change in consumer preferences regarding how many vehicles individuals own as a result of an increase in teleworking? That is, do you expect a reduction in the total number of sales after the pandemic?
It's a fantastic question. I think it's key actually to not only the near term, but also the long term. Prior to the pandemic, the assumption was that vehicle ownership was going to be challenged for the long term, principally for two reasons. Affordability of new vehicles is becoming more and more out of reach for a traditional family. If you do just the income to cost of vehicle, the average sticker on a new vehicle is over $40,000 now. So when you do the math, you realize that a median household is not the type of household that would be buying a new vehicle and driving that market. And we're on a trajectory that the expense of those vehicles is going to get worse because of the technology, electrification, that eventually gets us to an autonomous world in the future. But part of the reason why we think the vehicle ownership over the long term is going to decline is because there's going to be alternatives. And we were seeing that in the growth of ride hailing. We were seeing that in the growth of new offerings like subscription services that initially have been catered to the wealthy, but we see a path for that to be combined with used vehicles and potentially help address the affordability issue. But then we had the pandemic. Ride hailing is one of the metrics that we're tracking with Verisk. It's been more dramatically impacted than car rentals so far, just like not quite as bad as public transportation, but very close. So consumers actually in this near term, we've seen potentially a growth in demand for consumers wanting personal vehicles as an alternative for any type of sharing or riding public transportation. In the US, I don't think that that's been as big a factor outside of a few key markets like urban San Francisco, Boston, New York, the District of Columbia. The District of Columbia actually year to date has had some of the best performing sales metrics, and it's got the lowest vehicle ownership in the country. So it would indicate that potentially that's happening there. But your question actually hints that once we get over this wave, will we actually see a reduction? If people don't need to use have multiple vehicles, two different people in the household daily commuting, and I think we will see some shifts. I think some on the margin would potentially reduce, especially if they feel more comfortable with alternatives like ride hailing or a subscription service or ride renting. But you also potentially are seeing a change in vehicles. When our primary mileage is coming by ourselves, driving a vehicle into work and back home every day, it's very different if your focus is more on road trips and getting lots of goods at Costco. And so I think we're seeing a shift, an even bigger shift to bigger, more expensive vehicles, because people are looking for a vehicle that can address multiple use cases rather than limiting the cost of gasoline and easy to park in garage structures. So I think we're going to see some changes play out for years that may take a while for us to truly see what happens with vehicle ownership.
Well, I'm going to stress your forecast here. Last year, we held our automotive panel at your offices in Sandy Springs, which revolved around, as you mentioned earlier, the idea of an autonomous fleet, largely EV-based. Two components of that, one of which is a change in sort of consumer behavior that would cause an increase in demand for that kind of a product, which I'll just broadly coin transportation as a service. But there's also an infrastructure component behind that as well. I mean, we currently just don't have the infrastructure to effectively deploy a full EV fleet right now, nationwide at least, maybe in small markets, like you said, but at least nationwide. Do you see the pandemic perhaps accelerating some of those plans as part of like a public works initiative, kind of like what we saw back during the financial crisis with some of those quote unquote shovel-ready jobs? And do you see this at some point kind of taking hold?
I think it has the potential. I think it's one of the more promising regulatory policy change things that are likely to tilt more towards infrastructure spending as well as greener technologies, so encouraging further EV adoption. And we're definitely seeing that in other countries, in Europe and in Asia in particular. So I do think that and you can see it reflected in the stock price of Tesla, for one. But this week, today, we had the Nikola GM announcement with the electric vehicle the partnership there. So definitely the market believes we're moving to that future, potentially even more aggressively as a result of the pandemic.
Mike, did you have anything to add to that? You're good?
Yep. Yeah. Jonathan's got that.
Cool. Do you want to move to your to some of your slides? Sure,
absolutely. Okay. So kind of alternative data 101 kind of is where we wanted to kind of dive into very quickly before we got to the kind of open Q&A area. And we've been really fortunate. Obviously, we live in a time when there's literally technological breakthroughs happening so often with data and being able to capture things that a lot of times I think we as individuals, and certainly us as economists and market watchers, we almost take it for granted because these things are happening. But things like big data and things like the Internet of Things, there's tons and tons of individual user data. Much of it's much more frequent than traditional economic data. And if you could pop up some of those slides, you could see, particularly for the virus stuff, this has really been a godsend that we've been able to have this data, and some of it be on a weekly basis, some of it's certainly on a daily basis, even some of it's even more frequent than that.
Okay, I'm going to have to call an audible here. Jonathan, I'm going to ask a huge favor. I'm going to email this deck to you. Unfortunately, I'm running into permissions issues on my laptop for some odd reason.
That's okay.
It
That's right.
Require me to literally shut the entire meeting down and restart, which we're not about.
No, we're not going to do that.
Yeah.
I could fly without it. It's fine.
Okay.
Like a lot of trends, the trends that were already there were accelerated with the pandemic. We've seen a lot of private companies sharing a lot of data, plethora of this really rich data that dives a little deeper. Jonathan showed some of that. It's really has been incredible. But this example of whether it's open table bookings data, it's something that we the world, we didn't have access to. It's literally based on millions of reservations for restaurants across the U.S., or things like Apple mobility data. So again, the open table data, it's by state, it's by city, it's by day of the week, which is incredible. This is great stuff, and really on some level you start looking and you lean back a little bit and you're like, wow, traditional data, hey, weekly data, that's passé now. This is really old stuff. And certainly monthly data, it's downright quaint. But if you talk to anybody in our world that is like, what do you mean you don't know how many passengers went through the TSA checkpoints yesterday? Like, are you kidding me? You're so out of touch. And certainly Jonathan and I, he mentioned a number of things that he's looking at, but there's a lot of data that, and I'll just kind of mentioning them, whether it's open table, Apple mobility, I mentioned Google community, and even slicing within those various pieces. There's the opportunity insights that we're getting from Harvard, and that program, that's and again another very rich data set. It's showing us almost daily retail sales by area of the country and the type. It's incredible data. Weekly U.S. hotel results. It's not something that was publicly available either, from STR among others. Certainly we've had Harris polling, which is long been doing polling, but adding a whole nother layer and subset of COVID-19 related tracker data. Certainly there's been a number of others like Kronos adding U.S. workforce activity reports. So this is literally time clock punches and showing how long work shifts are and how many shifts there are actually being punched on a daily basis. This is incredible data. Again, it wasn't just, hey, we at Truist didn't get it. It wasn't even available. These companies weren't sharing this data. So this is great stuff. And then as Jonathan mentioned, things that Equifax and others, Verisk and others that are like this weekly loan report, talking about how many accommodations are happening. So it's really giving a lot more color as to what's going on. And then lastly, I would mention there's some others kind of tried and true. Bloomberg, Neff, they've had TomTom weekly traffic stuff that's kind of, again, supplementing. They were doing some of this stuff, but adding in a number of other things. And then there's some things that kind of were overlooked, things like the American Staffing Association. They have a staffing index, among others, that has been out there for several years, but really didn't get a lot of attention. And that's something that we're paying attention to. But it kind of gets us to well, how are you using this data and are you incorporating it into your forecast? first let me address kind of big data and the data sets and what have you. I personally don't use big data. All of the data sets that I use are really technically small data. They've been cleansed and massaged and cleaned up by some sort of third-party data provider, the usual suspects, Bloomberg, Haver, etc. Jonathan does use some, and I'll let him touch on that when we kind of open up here. But again, answering this question of, can we use these new data sets and this alternative data for forecasting? And unfortunately, the spoiler alert is we can't really. There's some issues with it, at least from a forecasting perspective. It does let us see additional color, and I'll get to that. But again, as to the why, really it comes back to data integrity, overall forecast. Oh, look at that! Now we pop some. But we'll flip through them in a second here. So this is showing go ahead and flip forward, Brian. That's fine. This is showing new case stuff and hospitalizations and the death rates and what have you. And again, this has been extremely helpful to provide us with an understanding of what's going on. This one's showing certainly some of the reopening progress. An excellent one up in the top left there is from the New York Fed. But this isn't a new data series. This is something that was out there, but again, wasn't getting as much play. Top right there, U.S. mobility trends. That's the Apple stuff. There's some issues there. TSA checkpoints, pretty good stuff. It tells us how many people are going through, but it doesn't give us really any history. It gives us some year-over-year numbers, but what did it do during the last recession? We don't know. It's not telling us that sort of thing. So this history problem is probably the biggest downfall for nearly all of this new alternative data. What did it look like last year? I don't know. What did it look like in the 2 recessions ago? I don't know. What about seasonality? And Jonathan touched on some of that. There's some week over week differences and certainly year over year differences, but is this a summer thing? Is this because of other factors? We don't really know. And so obviously, and we've got some people that are listening in today that are hardcore analytic types, not just Brian, but no history means no regressions and a lot of other things. So it really means using it in a forecast, it's just not reliable enough data, and it's just not stuff that we would want to base an entire forecast on as a new input. Is something that may, in the case of some of these things, maybe OpenTable is going to turn around in 6 months after we get through some of this stuff, or in a year, and say, oh, we're not providing that data anymore, or now we're starting to charge for that data. So this reliability and access and what have you are things that are additional hurdles. But again, the biggest downfall, I would say, really is history, because we don't have a long enough track record with some of this stuff. And certainly it's just a limited data set. So you can make some inferences, and we can certainly extrapolate, as Jonathan showed, that activity is improving since the pandemic, and that is very useful and definitely gives us a lot more color. But using it for forecasting, I think, is problematic. So
maybe said a little bit differently, back during the last recession, there was a significant change in consumer behavior. Not that the spending stopped, it just shifted into other areas, right? So you saw the rise of brands like Tesla and Lululemon, right? Become sort of the new luxury brands where year prior it was Louis Vuitton.
Yeah. If you flip forward just a couple slides before we kind of get into the showing, so this is a good one. And this one is that Opportunity Insights economic tracker that is coming ultimately from the Harvard team. And it's great stuff. And in fact, showing here, this is high income area spending, low income area spending, and middle income area spending. And we could see that particularly after mid-April, when the CARES checks came out that Jonathan talked about, we saw spending rebound very sharply. But some of it's still impacted. The most impact is in high income areas. And I think a lot of that has to do with some of these things, particularly that are leisure and hospitality related, not going to concerts, not going to certain restaurants and what have you, particularly white tablecloth restaurants or sit down, fine dining, whatever you want to call it. that's a big impact in some of these high income areas, and that's going to be impacted for the foreseeable future. If you flip to the next one, this one gives a little bit different slice. On the left side, showing the percentage of businesses, this is from Womply merchant data, that 19% of the companies, small businesses that were accepting charges, still aren't accepting charges. So there was an increase, and now we've seen really since July, when it kind of had this near-term peak, that it's kind of rolled back over. That's not a good sign. But I can't tell you what it did in the last recession. I can't tell you what it did 2 years ago. Womply doesn't have that data. And certainly on the right side, again, married up with it, is that we saw since first quarter to second quarter, we saw this percent change. What did it do a year ago? What did it do 5 years ago? What did it do 10 years ago during the great financial crisis? We don't know. We don't have that data. So again, using it for some of these other purposes, particularly hardcore forecasting, I think is, again, problematic. And then if you flip to the last one, again, just sharing some of these data sources that we've been using to do some of this, again, additional color. Jonathan and myself, again, this is an exhaustive list, but this is just some of the ones that we came up with.
So maybe forecasting utility is limited, but when we had BLS Director William Beach on back in March, he noted that because of the lower response rates and because of the inability to do deep in-field surveys, it's injected some amount of uncertainty, right, in the data that they're collecting on the labor market.
Absolutely.
Could alternative data in some sense, or is that something that you're using alternative data for, to help kind of maybe validate, right, sort of the fundamental economic data that we are getting that may be a bit more uncertain now than it was a year ago?
Yeah. I'd love for Commissioner Beach and others in the, if you will, traditional world of government data, which we still very much rely upon, and I think more or less others do too, to start incorporating some of these other data streams within some of their processes. And as he mentioned in a couple of other venues, not just ours back in May, but that they're using a lot more digital reach to get to companies and for companies to provide feedback. So that's at least something to look forward to. And again, there's some limitations there, because they are, if we're worried about consistency and all those things, the BLS and these other traditional data providers are even more so concerned to make sure that there's unquestioned reliability in this data. That said, we all know without fail, nothing's perfect. And as crazy as it might sound, they're like, man, how can we say nothing's perfect? You should go see some of the international data. It's a nightmare. So I'll just kind of leave it at that.
I want to make sure we get to two audio, or actually I guess now 3 audience questions. First one, do you see any impact from the election on your projections for 2021 and beyond, whether that's presidential or from what's happening in the Senate? Either one of you guys, I'll let you take the ball.
We're not making any changes to our forecast based on a change in the Senate. The bigger thing, and this is more a historical piece very quickly, is that as much as individuals want to overweight this amount of change that can happen with an administration change, or in the case of the Senate, unified government of House, Senate, and White House, even when those happen historically, and not just in the last few election cycles, but over the last 75 years or so, even when there's unified government, they don't get to do a laundry list of changes. They really only get to do one thing. So let's just say magic wand, the blue team gets total control for a couple of years. What's that one thing going to be? Is it going to be healthcare? Is it going to be infrastructure? Is it going to be undoing the tax policy changes that were done in 2017 and into 2018? Whatever that one thing is, that's they're going to get one crack at it. And even in the early Obama administration, his first term, when they had not small majorities, but rather large majorities, they had a tough time passing health care, the what came to be known the Affordable Care Act. So I kind of leave it at that. We don't want to overweight how much change can really happen, particularly in the Senate, and even with a few people as a majority. That said, things like filibuster might get changed, and that might make it easier to make some changes on the margin, but I don't know that we're going to have big wholesale changes that everyone expects.
Gotcha.
Jonathan, you're
on mute. I don't know if you
mute.
have anything to add there. You can get you on mute.
Sorry, my screen changed and wouldn't let me unmute it. I agree with Mike in what he said for approach. I would say that there's potentially two positives regardless of who wins the election. Number one, we take off uncertainty to a certain degree, that we think that whenever the outcome is final, which we are nervous that this won't necessarily be the day after in November, that will take away some uncertainty, and therefore the beginning of the year is likely to see positive movement on things like consumer sentiment, business investment, because the future is a little bit more certain. I do think you potentially have some policy changes. It's going to be important to figure out what those changes might be, whether it's with regards to taxation or regulatory. But one of the other near-term positives is if we remove that uncertainty and there's a clear winner, there may be more likely, if we still need stimulus, which I think we probably will, there's probably going to be more will to do that before the end of the year, after the outcome of the election. So I think those are two positives that start off 2021 on better footing than even we are right now. What happens 6 to 9 months later, that's left for us to figure out post-election.
Yeah. Good. We've got a question about, actually kind of a granular question about a specific data series. Mike, I don't know if this is something that you use. ICE, the Intercontinental Exchange, an Atlanta-based company, which also owns the New York Stock Exchange, publishes with Bank of America the MOVE Index. So that is what they try to construct is the implied volatility of the U.S. Treasury yield curve. So it's some weighted average of like 1 month out to 30-year implied vol. Is this something that you use, a series that you're familiar with or use?
Yes.
Yes.
Although part of his question was, is it intraday? I think it is on my handy dandy Bloomberg. That's right here, right next to me. Mm-hmm. But I don't know if it's intraday. I think it is. I don't know if it's available elsewhere other than Bloomberg intraday. I don't know.
Yeah.
But we do use it.
I like using it just to get a gauge of sort of where uncertainty is in the treasury market, which, I think if there's one sort of key takeaway here from today's call is that it's not just the level that is important, it's the uncertainty around that level that is important. Absolutely. And specifically, is it symmetrical, right? And having things like VIX or the MOVE Index or I think it's the CBOE publishes the 10-year Treasury futures implied vol index as well, things called TVIX or TYVIX. Those are all important things to kind of get a gauge of, because that can sort of give, let you know what, how certain the market is about the forward path of the economy, more broadly speaking. I will say though, when it comes to intraday stuff, to be a little, institutional details matter greatly with intraday data, especially when you have constructed indices like that. Specifically, if you don't have enough trading, then how are you coming up with updated values for the other parameters that are part of the calculation? It can get really messy, and so it's often that people use closed data, because after the markets close, there's an entire settlement procedure that cleans up all the prices and makes sure everything's just sort of kosher. But that was a really great question. I'm actually really chuffed that somebody brought up some financial market data. And then lastly, are you guys going to be able to post any of these decks online, or is this sort of for our eyes only?
Yeah.
Well, the recording is going to be posted, so
Recording will be posted. Yeah,
there's that.
yes.
So
According to
probably that.
Brian, you can definitely post mine.
Fantastic. Okay. All right.
Yeah.
With that, gentlemen, I really appreciate your time. This has been an exciting discussion, having two absolutely gigantic colleagues, bat heads over some of the most pressing issues that I think faces the profession as we see it right now. So thank you very much. And I'm going to hand it over to Jessica to give out some sort of concluding remarks.
Thanks, Brian. I'll keep it short. Thank you, guys. This was a treat. We've been talking about it for years to get our board up on deck and out there presenting, and I don't know why we waited so long. This was great. Thank you. The one thing I'll say is we hope everyone will plan to join us on October 21st, 2020. Our guest speaker is Michael Skordeles. He is currently president of the Upjohn Institute for Employment Research, but before that, in 2019 and for many years before 2019, he was at the Bureau of Labor Statistics. He was head of publishing the National Civilian Unemployment Rate, the monthly payroll job number, so he's truly an expert on employment numbers, and he plans to talk about the labor market in COVID next month. So we hope to see you then. Thanks for joining us, and we'll talk to you soon. Bye.